Hi everybody, Lance from ThetaTraders.com here. In this video we're going to go over more fundamental analysis. I'm going to be doing a string of videos based on this, mostly on the fundamentals and how to find companies that should be pretty adequate in the long term. And then I'm going to look at future videos on how to use option selling techniques to benefit from taking a premium, taking capital gains and whatnot. So there'll be quite a bit of series of videos. Click like and subscribe down below, and we'll make a playlist on all these videos as well, so you could easily refer to them. This video I'm going to go over the PEG or PEG ratio. PEG ratio is a good indication on if the price to earnings that are currently available are pretty adequate and not super high growth rate. We're also going to look at the price to earnings divided by the expected growth rate. So I'm going to go over the definition of it, look at how to screen for these positions, and how to possibly take these trades. So let's get to PEG ratio. First, you want to learn what the price to earnings ratio is. That's a PE ratio. Widely used stock evaluation measure. The price to earnings ratio is given by dividing the last sale price, so that's the price part, divided by the average earnings per share for a certain time period. So if you have a stock where the price is very high and then your average earnings per share are relatively low, your PE ratio will be very high. In a lot of growth type companies, you're going to be seeing a lot of high prices and possibly high earnings. However, when you divide the price by the earnings, you're typically going to have a pretty high PE ratio. Growth stocks like Amazon, Nvidia, and whatnot, they have very high price to earnings ratios because the price is pretty high. Other value type stocks, like blue chip stocks, typically have lower price to earnings ratios. To find the PEG ratio, though, you're going to take that price to earnings divided by the growth rate. So if the PE ratio is currently a little bit lower, and then you divide by a pretty high growth rate that's going to happen in the future, then you could get a pretty low PEG ratio. And that is an indication that it's a fairly valued or possibly really good value stock. If the PEG ratio is very high, then you want to be careful because it would have to continue growing at a really high rate in order to keep the PE ratio and the price at a good shape there too. In general, you want your PEG ratio to be under 1. You don't want negative numbers either, just because the negative number means the growth rate is probably negative, and then it's going to be very tough for it to come back up. If you go to finviz.com and then you click on the screener, you could go to the fundamental screener right here, and then you could do PEG ratio under 1, and this will very quickly show you what the PEG ratio and pretty good value companies, just based on this initial condition. You could look at a few other ones like PE itself, maybe under around 25 or so. And then you could get different results there. You could look at the earnings growth the next 5 years. Typically, you want that positive, for instance. You could do forward PE. Your forward PE probably doesn't want to be too high either, so maybe under 25 as well. And a few other things I'll talk about in future videos, but EPS growth next year could be helpful as well. You would want that to be positive. So these are some possible positions that you could look into to actually buying the stock. Maybe sell covered calls that are a little out of the money if you want to take in some income, or maybe acquire shares at a pretty good value at this point in time. Just looking at some random ones, you could do other descriptive stuff here. So you probably want to have relatively high volume, relatively high market cap. I would probably go at least mid, possibly large. And you could try to narrow it down a little bit. 67 positions sounds pretty good. Let's just look at CCL because I currently have a position there where I'm doing a covered strangle on it. So right now, Carnival Cruise in the last few months or so, has went from the 28 all the way down to 20. So it's in a pretty low value right now. You could see how, this is a 3-month chart, by the way. So you could see that the PEG ratio for this stock, and you can just Google it. Look at CCL PEG ratio as of March, pretty much right at 0, which is something to consider. If it's negative, then you'd want to be careful on it. But other positions could be more adequate. Let's just look at a few more. Deutsche Bank, maybe, DB. So DB PEG ratio. And this one's around 0.4, which is a good number because it's less than 1. Potentially undervalued stock as well. Nasdaq.com will show that as well. And you can also go to seekingalpha.com to look at possible more financials like earnings growth, income growth, and whatnot. So now, if you look at, say, DG, that's Dollar General, sorry, DB. So DB Deutsche Bank is currently been in a good run up. So it's at the 24 right now, and you can see how it went from around the high teens 20 all the way to 24. So this might be one that you might want to wait on, leave it in a watch list, and then look for a possible gap down. So if it gets down around the 21, 22, that could be a good entry point in terms of getting in at an even better value. And remember, these are for long-term positions, for long-term buy and hold, and you'd want to just be getting in at a good price so then you could see an eventual run up. It may not happen right away, but it could happen over time. And then if it does run up, you could consider selling covered calls, possibly out of the money, to get out of the position at a good capital gain profit, and you'd also take in income. So hopefully this video was helpful. If you have any questions, leave a comment down below. If there's any other fundamental analysis type things you'd like to look at, let me know as well. And I'll see you guys on the next one.